Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm your host here at AlgoBot, and in today's lesson, we're studying an expert advisor called Ema Band Bounce. It's a with-trend pullback approach built around a Keltner channel, which is an exponential moving average spine wrapped in volatility rails. Over the next few minutes, you'll learn how it reads trend direction, how it waits for price to dip into a rail and recover, and how it manages its stop loss and take profit. Remember, this is educational information only and not financial advice. Let's get started. So what exactly does the Ema Band Bounce expert advisor do? At its heart, this is a with-trend pullback strategy. In plain language, that means it does not try to catch tops and bottoms against the market. Instead, it waits for the market to already be moving in one direction, and then it looks to join that move on a temporary dip or rally. Traders often call this buying the dip in an uptrend or selling the rally in a downtrend. The engine behind the strategy is a Keltner channel. Picture an exponential moving average running through the middle of price. That central line is called the spine, and it is calculated with a default period of 20. Around that spine, the strategy draws two rails, one above and one below, each placed a set distance away using the average true range, a common measure of volatility. By default, those rails sit 1.8 times the average true range from the spine. When volatility expands, the rails widen. When the market calms down, they contract. The strategy reads trend direction from the slope of that same moving average. It compares where the spine sits now against where it sat 5 bars ago. If the spine is rising, the strategy treats the market as an uptrend and only considers buying. If the spine is falling, it treats the market as a downtrend and only considers selling. There is no second time frame and no extra indicator involved. This approach may appeal to traders who prefer a trend-following mindset with clearly defined, rule-based entries and exits. It runs on whatever symbol and time frame you attach it to, since every calculation comes from the primary chart. As always, this is educational information, and trading carries real risk, including the risk of loss. Let's walk through the exact logic the expert advisor follows. First, the strategy only acts once per completed bar. It waits for the current bar to finish forming, then evaluates the freshly closed bar as its signal bar. This keeps decisions stable and avoids reacting to every flicker of an unfinished candle. On each closed bar, the strategy calculates 3 things: the moving average spine, the 2 volatility rails around it, and the slope of the spine over the last 5 bars. From that slope, it decides whether the market is in an uptrend or a downtrend. Now the entry conditions. For a long or buy, the strategy needs several things to line up at once. The spine must be rising, confirming an uptrend. The bar's low must dip down and touch or pierce the lower rail. But rather than closing weak, the bar must close back above that lower rail, and it must be a bullish candle, meaning it closes higher than it opened. Finally, the close must still sit below the spine, leaving room for price to revert back up toward the middle. When all of these are true, the strategy reads it as a pullback that buyers have stepped in to defend, and it signals a buy. The short side is the mirror image. The spine must be falling, confirming a downtrend. The bar's high must poke up into or beyond the upper rail. The bar must then close back below that upper rail as a bearish candle, closing lower than it opened, while still sitting above the spine. That combination is read as a rally that sellers have rejected, and the strategy signals a sell. Risk management is built into every signal. For a buy, the stop loss is placed just beyond the pullback extreme, at the lower of the bar's low or the rail, and then pushed a further 1 average true range beyond it. The distance from entry to that stop becomes the defined risk. The take profit is then set at a reward-to-risk multiple of that distance, 1.8 by default, meaning the target sits 1.8 times as far away as the stop. The short side works the same way in reverse. Finally, the strategy holds only one position per magic number at a time. It will not stack trade on trade. This is a deliberate risk control that keeps exposure simple and each setup independent. Let's look at the actual MQL5 code the expert advisor runs, shown here as it appears in the meta editor. At the top are the input parameters. EmaPeriod, defaulting to 20, sets the length of the moving average spine. ATR period, at 14, controls the average true range used for the rails, and the stop. Band multiple at 1.8 is how far the rails sit from the spine. Slow pullback at 5 is how many bars back the strategy looks to measure trend. ATR multiple places the stop beyond the pullback extreme. RewardRisk sets the take-profit multiple, and lots and magic define the fixed trade size and identifier. Below the inputs is the buy block. You can see the long signal is a chain of conditions joined together. It requires an uptrend, the bar's low reaching the lower rail, the close reclaiming that rail, a bullish bar, and the close still below the spine. When every part is true, the code reads the ask price as the entry, sets the stop loss just below the lower of the bar's low or the rail, -1 average true range, calculates the take profit as the reward to risk multiple of that distance, and calls trade.buy to place the order. The sell block is the mirror image. The short signal requires a downtrend, the bar's high reaching the upper rail, the close back below it, a bearish bar, and the close still above the spine. The code then reads the bid price as the entry, places the stop just above the higher of the bar's high or the rail, +1 average true range, sets the take profit the same reward to risk distance below entry, and calls trade.sell. Both sides share identical, symmetrical logic. Now let's bring the whole strategy to life on a chart. On screen you can see a candlestick sequence with the Keltner channel drawn over it. The gold line running through the middle is the exponential moving average spine. The two blue lines above and below are the volatility rails, each set 1.8 times the average true range away from the spine. Watch how the rails breathe in and out as volatility changes, and how the spine leans upward, then rolls over and leans down as the chart progresses. We begin on the left in an uptrend. Notice how the spine is sloping upward, bar after bar. That rising slope is the strategy's trend filter, giving it permission to look for buys, and only buys, while the market climbs. In the first couple of candles, price drifts along above the spine, and then it starts to pull back. This is the moment the strategy is waiting for. Price dips lower, and the candle stretches all the way down to touch the lower rail. A weaker system might give up here, but watch what happens. Buyers step in, and that same candle closes back above the lower rail as a bullish bar, while still sitting below the spine. Every condition is now satisfied, and the buy entry marker appears. The stop loss is tucked just below the swing low, beneath the lower rail, giving the trade a clearly defined risk. From there, watch price respond. The next candles push up off the rail, back toward the spine, and then through it. The uptrend reasserts itself, and price climbs candle by candle, each one closing higher than the last. Because the take profit was set at 1.8 times the risk distance, the target sits well above the entry. As price rallies into the upper part of the channel, it reaches the take profit marker, and the long trade is complete. That is the buy the dip idea in action. Join an existing uptrend on a temporary flush into the lower rail. Now the character of the market changes. Watch the spine flatten near the highs, and then begin to slope downward. That falling slope flips the strategy into downtrend mode, where it will only consider selling. Price makes a lower push, then stages a rally back up. On the candle marked for the sell, price rallies hard enough for its high to poke into the upper rail. But sellers reject that push, and the candle closes back below the upper rail as a bearish bar, while still holding above the spine. That is the mirror image of the buy setup, and the sell entry marker appears. The stop loss is placed just above the rejection high, above the upper rail, again defining the risk before the trade is ever taken. From the sell entry, follow price down. The rejection at the upper rail gives way, and the candles roll over one after another, each closing lower than the last as the downtrend carries price back through the spine and toward the lower rail. With the take profit again set at 1.8 times the risk, the target sits well below the entry. Price slides into it, and the take profit marker is reached, completing the short trade. That is the sell the rally idea. Join an existing downtrend when a bounce into the upper rail is rejected. Notice the symmetry across both trades. In each case, the strategy waited for the trend to be established, waited for price to stretch to the far rail, and then required the bar to snap back and close on the right side of that rail before committing. The stop always sits beyond the extreme of the pullback, and the take profit is always a fixed multiple of that distance. It is a patient, rule-based way of joining trends on a pullback, and it treats risk and reward with the same structure on both the long and the short side. And that brings us to the end of our breakdown of the Ema Band Bounce Expert Advisor. Today we explored how it uses a Keltner channel, an exponential moving average spine with volatility rails, to read trend direction from the slope of that spine. We saw how it looks to buy pullbacks into the lower rail during uptrends, sell rallies into the upper rail during downtrends, and how it defines its stop loss and take profit on every trade. Remember, everything in this video is educational content only, and not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this helpful, please like the video, leave a comment, and subscribe for more MetaTrader 5 strategy breakdowns. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.